Hey everyone, it's PJ Patterson here for Market Update. Today is Sunday, the 2nd of May. Hope you're having a great weekend. I'm in the office catching up on a few things. Didn't get a chance to do the market update on the Friday, so thought I would, while I'm here, go ahead and shoot that out in case you're chilling out here on a Sunday and would like something to watch or listen to. So top three things today. I think we're set up for a big May Meltup, and I'm going to talk about that. So topic number one, or item number one, is the May Meltup. Number two is earnings and what's going on. Just give you an update on what's going on with earnings. They're just, at the moment, ripping to the upside, so we're going to talk briefly about that. And they're really just going to revisit the whole inflation, GDP, and kind of where we're at economically. Again, quad two, we're definitely there. So what's happening right now in the markets? Well, let's have a look at our good old friend, the commodities. No, that's earnings. That's in a second. Where is my, nope, sorry, wrong chart. I'm trying, there we go. There's the chart I was looking for, the table I was looking for. So this is the commodities futures trading positioning. And we continue to see, I think I called this out last update, but we continue to see these bearish positioning in the market. And what this negative 195 means is that and if you go over here to this part, or this column here where my cursor is, you can see that currently non-commercial, which is basically the public, is net short things like the Russell, the Dow, the NASDAQ, and the S&P. But the market has been making new all-time highs in the S&P. The Russell's been hitting new highs. The Dow has been hitting new highs. The NASDAQ has been hitting new highs. So all of these markets are going higher. And I don't know why the public must think that we're still in a bear market, or they're worried about all this, or they're worried about, COVID, or I don't know what they're worried about, but they're wrong. This is the dumb money that's out there positioning themselves. And this is, again, why I think we're going to see a fantastic May. We're going to see a May melt up. The market's simply not bullish enough. And that bullishness that I have stems from a couple of things. First of all, it stems from earnings growth. Now, I talk a lot about earnings. We do talk about it at earnings season, and we're about halfway through getting companies reporting. I think this week we'll have a whole bunch more reporting, so that we'll probably be at a majority, if not more than a majority, of the S&P 500 reporting earnings. And as you can see here, we've already had over 200, over half the S&P reporting. And look at these earnings numbers; these are just stellar, and particularly in the markets that we're invested in. So look at energy; it's just ripping to the upside. Materials is crushing it. Industrials, they're a little bit, still need to be there, but we're heavily invested in industrials, and they're going to continue to see good earnings growth. But things like financials, which again we're invested in, are just killing it, and other segments of the market too, as you can see, are performing reasonably well. Unfortunately, our friend in the utilities market, which we do not own any of that because that's more of a defensive asset and very interest rate sensitive, by the way, is having down earnings. So probably no surprise there. Anyway, that's just a little update on earnings to show you that, again, I think the market is not bullish enough. So what typically happens with earnings is you get analysts and pundits out there on Wall Street will put out what their projected earnings are for companies, and they have all sorts of models that they use to do that. But they are not bullish enough. And I think that's evidenced by the fact that, again, this commodities report is futures report is still showing that there's quite a bit of bearishness there. Furthermore, for whatever reason, people seem to think that the dollar, the U.S. dollar, is going to begin to strengthen. And this couldn't be further from the truth. In fact, the U.S. dollar, I'm going to show you a chart in a minute, it's on a lag, but it is potentially about to get absolutely slammed. And this is a good precursor of that. You can see here that in terms of the yen, the euro, the Swiss franc, a couple of other smaller currencies here, people are very bullish on the dollar, and they shouldn't be. So it'll be interesting to see as these currency positions unwind, these futures contracts unwind, what that does to the US dollar. It's probably going to send it lower at this stage, as again, quad two, which is what we're in, is where one of the quads, the dollar does not perform well. And in fact, the dollar doesn't do well in practically any quad except this, the US dollar I'm talking about, except for quad four. So again, that'll be interesting to see what unfolds there. Now, just moving on to sort of inflation, GDP, and a bit of a broad brushstroke on Quad 2. Just to remind you, I start with the quads. That's where we always start. What's the macro positioning at the moment, the macro position? So the macro position, again, is we're in Quad 2. This is the reflation quad. This is where growth is accelerating, inflation is accelerating, interest rate policy is getting a bit interest rate policy is getting a bit more hawkish. So we're seeing the potential that interest rates are going to be rising. We are seeing that, right? If you look at, for example, let me just grab a chart of the 10-year here. If we look at a chart of the 10-year, we see that this is a 10-year Treasury in the U.S. We see it has been doing nothing but going up. And we've been in a bit of a consolidation period here the last couple of weeks. But the 10-year Treasury is poised to move higher. And that's because the bond market continues to signal that it is anticipating and it's beginning to price in. Well, it's not beginning to. It has been pricing in inflation. So that's showing up in other quarters of the market. It's a chart I show you all the time as well, the commodity CRB commodities index. This thing's been ripping. I mean, look at from November when we sort of went bullish on inflation and the markets and everything else. Look at this thing. It's up and to the right like you wouldn't believe. So it's going to continue higher. Again, we've had a little bit of a consolidation period, and now it's just launched off of that. So again, the commodities market, the bond market are all saying, hey, we have inflation and we have to price that in. Now, there's a couple of other charts here I just wanted to show you because they relate to sort of macroeconomic things. So I'm going to come back to the durable goods and stuff like that. But look at this. I touched on this last update. The consumer has rebounded massively and confidence has shot up. Like, look at this. That's a parabolic move up. It went from, I don't know where this was, a low somewhere in the low 70s probably, and it's just shot up to 139 on this particular, what this index is showing. And we've seen other periods of time, where it's shot up. And look at these moves. I mean, we had the 90s recession. The consumer confidence just went down into the toilet from 140-ish down to 20. I mean, that's a horrendous move down, but then just rebounded and rocketed higher again. Again, we had a recession in 01, 02, and again, confidence fell back down, bounced back up nicely. We had the 08, 09 recession. Confidence tanked and ripped up to the upside. And of course, we've had this 2021 period of just confidence falling off a cliff. I don't think any of these other down moves were as sharp and as severe as the one we've had. And it's bounced back nicely. Again, this is telling us, I think I mentioned there's like $2 trillion worth of spending that the consumer is going to be doing. They're booking holidays. They're going back out to eat. They're going back and getting back to normal life. Guess what? That this is one of those metrics that is telling us that that's exactly what the consumer is thinking and exactly what they're doing. Now, here we go. Durable goods. This is, again, one of these metrics that follows on from the consumer confidence stuff. Durable goods are things like washing machines and airplanes and all this kind of stuff. Look at this bounce. What a bounce. We've seen similar bounces before, and we're not quite eclipsing previous metrics yet. We'll probably see a little bit more to the upside here. But again, this is telling us, once again, we are in Quad 2. We're in the reflation expansion part of the sine curve of the business cycle. And if you look at there you go. There's U.S. durable goods, X aircraft, and X defense. Again, huge bounce off the COVID lows. And is there another one? Oh, capital goods. That's moving up strongly and is a green number. So all of these metrics, all I'm telling you, ladies and gentlemen, all of these metrics are signaling to us that we are well and truly in Quad 2. And we have yet to see all of that fully play out in terms of the environment, in terms of the stock market and seeing higher stock prices. Now, just quickly, I'm going to just pull our good friend here, Interactive Brokers, over and just talk real briefly about some of the things I typically hit on. Volatility, again, just to hit on that metric, the VIX index is well into the bull market range, and we're seeing small spikes in vol, but volatility seems to be losing steam. So excuse me, if you look at this vol chart over that's a sort of a daily chart, but we have these big spikes in vol and big recoveries in it or drops in volatility. Then we might have an episodic spike, boom, and it comes off. And spike, boom, comes off. Another spike, boom, comes off. Anyway, and its trend though is down, right? This is the whole point. If you look at this, the trend, if you connected a line here, it is down. If you connected a line here to here, it's down. This is great. This is a good sign that people are coming. It's safe to go back in the water. Now we've been back in the water for a while now, right? Because there are no sharks circling at all. We're not going to get gobbled up, but this is one of those front run metrics that that I use to make sure that we're positioned right. Anyway, I always talk about volatility, and one of the things I want to remind you of with volatility is if you're watching your account every day, and I know a few of you are watching your account every day, the first thing you should do if we have a down day or something like that is to check the volatility metrics and see what they've done. Now, I have my screen set up, of course, to show me the VIX and the VIXN and a few other of the vol metrics. And if I see that there's green there and they've spiked, one of the things I go back to then is I look at the risk range or the range of volatility. And again, what I can say to you is that with the VIX, its top end of its range is around 19 something. In fact, I'll tell you specifically and exactly what it was on Friday. The range on vol, the top end of that range was 1889. So here we are, 1861. Even if it went a little bit higher, that's fine. Went to 19, wouldn't be the end of the world. What it would actually do, I wouldn't mind if it popped up to 19 or even 20 as an episodic thing, because it'll give me some buying opportunities and some equities and a few other things. And so when we are in when we're in a downtrend in vol, when we get a spike in vol, that's something that we should buy, unless we're already fully invested, which we pretty much are. So I'm happy to just sit tight, sit on my hands, and really do nothing. Anyway, I think that's probably about all I need to share with you and show you today. But just to really just lock this off, and I suppose so exactly where I still sit. We are right in the throes of quad 2. There is nothing really in terms of strategy that needs to change. I have the right portfolio on. We're exposed to energy. We're exposed to industrials, materials, some good small cap exposure as well. Got a lot of Aussie exposure on. We are going to see a little bit of an influence of the currency, but I'm aware of that and I'm managing that. So if you see because of currency, you see some movements in your portfolio, don't worry too much about that. I have a strategy for dealing with that, so that's fine. But the point is that things like, as the dollar falls, things like oil and energy and small caps and all those things are going to continue to move higher. So there'll be a time when I pivot back out of the US dollar and back into the Aussie, and that's we're nowhere near that just yet. Anyway, I just thought I'd mention that to you. And finally, not that any of you have really expressed any consternation about anything. I think generally you'd probably be pretty happy that we performed well this year. So I think most portfolios are up somewhere between 12 and 15% so far year to date, and that's a phenomenal result. That's we're 5 months into the year right now, and I think the best is yet to come in terms of the performance that we're going to see this year. So again, my job is to preserve and protect capital such that when we do make the next pivot, I don't want to see any big drawdown in capital, and I want to be pivoting into the next move, which is probably going to be sort of global quad 3 with some possible quad 4. And that's not going to mean we're going to have an economic meltdown. It just means that the data and all the COVID pop is going to come off a little bit. It's going to slow back down a little bit. So it just means we'll have to reposition into some other types of sectors and some other stocks and things like that. But again, we got a lot of runway left for quad 2. And as you all know, I'm sitting here on the switch every single day. The market is open, and making sure that my primary objective, which is to preserve and protect capital so that we can compound it over time, is being met. And ladies and gentlemen, that is absolutely being met right now as we speak. So have a great weekend, or what's left of it. And if you do have any questions about anything, please let me know. And probably one final thing, I know Lady is sending out emails regarding superannuation contributions for the year. You still have a couple of months, obviously, to go. So my suggestion would be when she sends the email out, which will basically say you have this much that you can contribute to your super, what it's going to do as a concessional contribution, so as a tax deductible contribution. What that means is from the last couple of years, they've been rolling forward unused contribution cap. So as you probably know right now, the contribution cap as a concessional, so the amount that you can tax deduct is $25,000. It goes up on July 1 to 27.5, but it's $25,000. Now, if she sends you an email that says, oh, you've got, 25 or 26 or 30 or whatever the case may be available as a contribution amount, it just means that that's from prior years where you had unused cap. So if you do need any explanation of that, or you want to discuss strategies around that, or perhaps what you might do between now and June 30, because remember, you have to have the contribution in before, and it needs to hit the account before June 30 so that you can do something on this year's tax return about that. If you want to have a discussion about that, please do let me know. Otherwise, enjoy the rest of your weekend, and I'll look forward to giving you another update next week. See you later. Bye.